This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my market insights for Thursday, February 4th. Well, the UK referendum on the EU is firming up. European Council President Tusk has presented a 9-page paper setting out new terms for Britain's membership in the EU. The schedule is for this to be approved at an EU summit meeting on February 18th and 19th, which would pave the way for a referendum on whether Britain should leave the EU. The FT reported the vote's likely to be held on June 23rd. Now, I won't go through the arguments for or against leaving the EU, nor will I speculate now on what British voters will decide a few months from now. I'd only like to point out how badly the pollsters have been doing recently. From last year's UK election to the recent Iowa caucus, pollsters have been doing really badly. The UK referendum is likely to be particularly difficult to call because the arguments are quite technical and may not interest anyone, so sentiment and turnout will be hard to predict. To make matters worse, the polls about Brexit aren't even consistent. Some polls show more people in favor of leaving, while others show more people in favor of staying. And they're all unreliable anyway. So uncertainty surrounding the vote is bound to increase. The markets don't like uncertainty. So far, the market isn't pricing in that much concern. I believe the Brexit risk short sterling trade has plenty of room to grow. It's by no means a crowded trade yet, probably because of the monetary divergence long sterling trade that's still lingering. That suggests the market can get shorter sterling and sterling can fall further. For example, while the Commitment of Traders report shows that the speculative community is net short of sterling, their short positions are nowhere near as great as they've been previously. Nor are the sterling shorts the market's largest positions. Speculators are more short the euro, the Mexican peso, and the Canadian dollar, with monetary divergence and oil plays. If we look at the options market, there investors are clearly starting to get concerned. 3- and 6-month risk reversals, which generally track each other fairly closely, have diverged sharply as the 6-month risk reversal now encompasses the expected timing of the referendum. It's now down to where it was at the time of the Scottish referendum. However, the 3-month risk reversal got down much further back then, and both of them were lowered just last April, which suggests to me that the options market can still build positions. Finally, the monetary policy divergence theme may fade further too, as investors back off their expected timing for a rate hike in the UK and instead start thinking more about the possibility of negative interest rates. But that's a topic for another report. In sum, I think there's plenty of room for the pound to fall further as the UK's referendum on EU membership approaches and the risk premium on sterling rises. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.